Well, I mean, people have to wake up to reality, understand the threats, but you also have to put gold's price in perspective and realize that it started this century. In 2000, the price of gold was under $300. So for gold to go from 300 to 1800, I mean, I know that doesn't excite people in the Bitcoin world, but you know, for a commodity, especially gold, that is a very significant price gain. In fact, it's outperformed the S&P over that time period, even if you include the dividends that the S&P paid. And the gold doesn't pay any dividends at all because it's just a commodity. It's not a income generating company. So gold has already made a big move. Now, granted, over the last 10 years, ever since, you know, kind of Bitcoin had come on the scene, if you're simply looking at gold during the lifetime of Bitcoin, yes, you're not seeing a big move, and you may be scratching your head, hey, why is this happening? Well, A, you're ignoring all the things that happened before anybody was looking at gold because there was no Bitcoin. And a lot of other people are simply making the false logical conclusion that Bitcoin is going up and gold's not. It must be because Bitcoin is going up that gold's not going up. So Bitcoin is the new gold. Bitcoin is stolen gold's thunder. And I don't think that's the case at all. I think that to the extent that people are buying Bitcoin, the vast majority of people who are buying Bitcoin would simply buy some other speculative asset if Bitcoin wasn't around. I mean, most of them would not be buying gold. Some of them would, but I think the vast majority of the people who are speculating on Bitcoin are speculators by nature. They're not just savers. They're not just trying to, you know, store their wealth in something boring, like, you know, like a metal. But the reason that I think the more sophisticated, bigger money, the endowments, the institutions, the pension funds, the reason they're not looking at gold, and of course they should be, is because they're way too optimistic, as they always are in a bubble, on the U.S. economy, on the stock market, on the risk assets. Nobody wants to hold on to a metal that is lagging the risk assets, I mean, the stock market and things like that. So people are concerned about their relative performance, and so they're not interested in gold. But they will become interested in gold at some point in the future once gold has significantly risen to the point where it's now beating a lot of these risk assets, meaning these risk assets have actually come down in price in relation to real money. You know, regardless of what they do in dollar terms, they come down in gold terms. And more people perceive the real threat of inflation, and they no longer trust the Fed in its bluff that it's transitory, that it's going to fight it. When people are really worried about inflation, the way they were in the 1970s, that's all going to change. And people should be even more worried now about inflation than they were then, because unlike the 1970s, we don't have the ability to do anything about it. Because the way we stopped the inflation in the 1970s was with Paul Volcker in 1980, letting interest rates go to 20%. Paul Volcker did, when you ask me, hey, what's the right thing to do? Well, Paul Volcker did it. He was the last Fed chairman to ever do the right thing. But doing the right thing means interest rates go way up. But the problem is we have so much debt now that we didn't have back then, and the duration is so short compared to what it was back then, we can't afford to do the right thing. Of course, that doesn't mean we can afford to do the wrong thing indefinitely. We can't afford to do that either. But we're going to keep on doing the wrong thing until there's a complete crisis in the dollar. And I think before we get to that point, more of these big investors will realize this, and they will be buying gold, and you're not going to see $1,800 gold anymore. Maybe it'll be $3,000 or $4,000 or $5,000 or $10,000. I think it's going much, much higher. And I think that the best way to play it for your audience, to the extent that you guys want to speculate, is buy the mining stocks. I mean, they've never been this cheap, really, in my entire career, and the sentiment is still relatively negative on the sector, even though the fundamentals couldn't be better. So that's where you get a real opportunity. You get a big mispricing of an asset. You don't have anywhere near the upside potential priced into these stocks. So they're great speculative buying opportunities. So you can either do the research yourself, or you can let me do it for you. You can, invest in my gold fund, the Euro Pacific Gold Fund, which you could buy at any broker dealer, a discount broker. You could buy it with my firm, Euro Pacific Capital. or you can set up a separately managed account. We manage portfolios for people of individual gold stocks. So you can do it yourself or you can hire me. But either way, I would encourage risk takers to do that. I mean, and if you're listening to this podcast, if you're buying cryptocurrency, by definition, you're a risk taker. And if you don't realize you're a risk taker, then you don't belong in cryptocurrencies. Well, unless the government changes the CPI, which I wouldn't put it past them to do, right? If they kind of decided to change the methodology for computing it. The CPI inflation in 2022 is going to be higher than 2021. And the reason I'm confident that that's the case is if you look at the producer prices, they have already risen quite a bit more. I mean, they're up 8-point-something% annualized this year. So businesses have been reluctant to pass on price hikes. The most recent one being 3M. Yesterday, they warned on their margins because their costs are rising too much and they haven't raised prices enough to offset those increases. And that's pretty much the story for a lot of big companies. They have been reluctant to raise prices, hoping that their increases in costs would be transitory. But as the year comes to a close, and there is absolutely no evidence whatsoever that that was the case, and in fact, it looks like the price increases will just continue, I think a lot of these companies are going to rush to make up for that lost ground. And I think we're going to see some bigger price increases on the consumer side in 2022 than we had in 2021. Plus, I think at some point in 2022, the government is going to have to come clean, at least to a degree, and raise owner's equivalent rent to be somewhat more reflective of actual rent. So I think at some point, we're going to start to see much bigger numbers for that component of the CPI. And so all that is going to work to make the number even higher next year than it is this year. The other reason that inflation is going to keep getting worse is they're not going to turn off the printing presses. They're going to keep on printing money. The deficits are going to keep on, growing. And so the Fed's going to keep on monetizing. And I think instead of tapering QE, they're going to end up expanding it. And so all this is going to pressure prices even more in the future than it has in the past. Just the real crash hasn't happened yet, but all the ingredients are there, and the crash is going to be bigger than ever. So the idea is to be prepared. And that's the other thing you can do. If you want to get prepared, you can prepare your portfolio. Most of your portfolio should not be invested in highly risky assets that can go to zero. Even if Bitcoin does go to $1 million, okay, fine. You'll make money on it if you have a small amount of your portfolio. But what you have to do is be prepared for what happens if it goes to zero, right? You don't want to get wiped out. You don't want to lose everything, especially if you're older. I mean, if you're a young kid, if you're like my son's age, it doesn't matter if he loses everything. He's got a lifetime to make it back. And, it's a valuable lesson. If you lose your money when you're 19, hopefully you end up making a lot more money over your lifetime, and you avoid losing even more money because you learn from the mistake you made as a kid. But if you're older, if somebody's listening to your podcast and they're nearing retirement age, you got to minimize, if you have any exposure to crypto at all, it's got to be very, very small, right? The bulk of your assets have got to be in more risk-adverse, lower risk assets. And when I'm talking about lower risk, it's not necessarily lower volatility, although anything has lower volatility than Bitcoin. I'm talking about getting out of U.S. currency. So being in real assets that protect you from inflation, but in a way that you can be assured that those assets aren't going anywhere. If I own stock in a business that's been around for 50 or 100 years, I have a pretty good idea that it's going to continue to stay in business. It's got good management, it's got a good balance sheet, and especially if it's selling products that I know people want, that people need, actually more important than what they want, what they need, and they have the ability to raise prices to cover their rising costs. And so you make the right investments in the right asset classes, then you can have a retirement that will survive a massive dollar devaluation and inflation, and it will continue to deliver real purchasing power into the future, which is what you need. You have no assurances with Bitcoin or any cryptocurrency. Maybe it will go way up, and maybe it will help provide for your lifestyle, and maybe it will be worth nothing.